So, welcome back. We're going to start with the first standard for the day, which is AS20, earnings per share. Friends, this standard is going to speak about only one rule, which is basically into multiple formulae. The earnings per share needs to be calculated and disclosed in the financial statements. Now, what is earnings per share? It refers to the total earnings available for the equity shareholders calculated on a per share basis. So total earnings to the equity shareholders per share is what is earnings per share. Now this standard speaks about three formulae that you have to remember, or three sets of EPS that we will remember. Basic EPS, adjusted EPS and diluted EPS. So three sets of formulae that we will remember here: basic, adjusted and diluted EPS. Now what is basic EPS? Basic EPS is nothing but the normal calculation of earnings per share, which says total earnings available to equity shareholders. It's not profits after tax, it is earnings available to equity shareholders divided by weighted number of equity shares during the year, or weighted average of equity shares held during the year. Now, what is earnings available to equity shareholders? So, we will have profit, sales, expenses, profits, after which we have interest, taxes, etc. Okay, so we find out profit after tax. Now, profit after tax minus preference share dividends will give you the earnings available to equity shareholders, right? So, for equity shareholders, it is very simple. We take the profit after tax or earnings after tax minus preference share dividends, right? Now, for the weighted number of equity shares, we need to take the weighted average based on the months or period for which the shares were outstanding. Based on the period for which the shares were outstanding during the year. Suppose totally there were 1 lakh shares and further 50,000 shares was issued in the month of, say, October. So 1 lakh shares will be for the first 6 months, and for the remaining 6 months it becomes 1,50,000 shares. So when we take the average, we will be taking 1 lakh for 6 months, 1 lakh into 6 by 12 plus 1,50,000 into 6 by 12. Similarly, if the period is going to be, say, after 3 months there is a fresh issue or a buyback, then in that case, accordingly, your total number of shares and time period needs to be altered, right? So weighted number of shares will be calculated based on the months for which the shares were outstanding for the period. Okay, so this is about calculation of basic EPS. Okay, so let's just take a simple example first for calculation of basic EPS. Shares outstanding is equal to 1 lakh as on 1st April. 20,000 shares issued in on 30th June and 40,000 shares bought back in on 31st December. So calculate the weighted average shares. Please calculate the weighted average shares. Here we can go on a cumulative calculation, which will be easier for us. Now shares outstanding as on 1st April. Next transaction happens as on 30th June. So which means April, May, June, 3 months, the total number of shares that was outstanding was 1 lakh. So into 3 by 12 plus. Next, 30th June the issue has happened. So July, August, September, October, November, December. So how many months? 6 months the shares have been issued afresh. So which means total number of shares for 6 months will be 1 lakh plus 20,000, which is 1 lakh 20,000 into 6 by 12 plus. Now subsequently the shares have been bought back, for which 40,000 shares have reduced. So now your number of shares that would have got reduced is 1 lakh 20 minus 40,000, which is 80,000 shares. So 80,000 into January, February, March. So 3 months. So 80,000 into 3 by 12. So taking this proportion, we will get how much? 5,000. 1 lakh 5,000 shares. So is the weighted average calculation clear? This calculation can be used in case of fresh issues, buyback. So whatever is the case, you can use this cumulative calculation for calculating the weighted average number of shares. Okay. And the numerator is simple. The numerator says total earnings available to excuse me, equity shareholders, which is profit after tax minus preference dividends. Right. So this is part 1, which speaks about basic EPS. Now coming to part 2, when EPS needs to be adjusted. Okay. 2 scenarios. We can remember it flat. 2 scenarios when EPS will be adjusted. One in case of bonus issue, second in case of rights issue. Okay. Now, for bonus and rights issue, additional shares are issued. Now, let's first understand about bonus, then we will come to rights. Okay. Now, in bonus issue, additional shares are issued for no consideration. So, for bonus, the consideration is nil. So, we will assume as if the bonus shares were issued in the beginning of the period itself. Okay, in the beginning of the year itself. So it is assumed that the bonus is issued in the beginning of the year. So why this assumption is made? Because there is no consideration that is received. Okay, now when you are going to assume beginning of the year, what will be the weight that will be given for the shares? Entire 12 months weight will be given for that bonus shares. Okay, so for bonus share, the purpose of calculating for the purpose of calculating weighted average, 12 months weightage will be given, will be fully given. Okay, this is for the year in which the bonus is issued. Now the year in which if you are having a bonus share, correspondingly the previous year earnings per share also needs to be adjusted. Okay, the previous year earnings also needs to be adjusted, and that is what is called as adjusted EPS. Now for the previous year earning, the bonus will be added, bonus shares will be added to the denominator as if the bonus was available in the previous year. Okay, so for bonus, 2 points to remember. First, in the current year, what we will do? Okay, let's remember it as a rule. Current year la bonus shares added with full 12 months weight. Correct? In the denominator. In the previous year also, bonus shares is added to the total equity shares for adjusted EPS purposes. Okay, so current year also we will add it, because current year anyways the bonus is issued, we need to add. Whereas more important is previous year also we need to add and show it in the denominator. Accordingly, your EPS calculation will vary. Is that clear, friends? Okay. So when it is bonus issue, please remember for the previous year also there is an alteration to be made. Second, rights issue. Now rights issue also additional shares are issued, but what is the difference? For rights there is an amount that is collected from the shareholders, a nominal value that is collected. It will not be equal to the market price, but it will be some nominal value that is collected. So when the rights are issued, adjustment is going to be made for this rights factor, or we call it as the adjustment factor. Okay, the adjustment will be made in the current year. Okay, and adjustment will also be calculated for the previous year. So both in case of bonus and rights, current year value will also be changing, previous year value will also be changing. Okay, now let us understand the rights adjustment for EPS calculation in the current year. First, we need to calculate theoretical X rights price. So what is this theoretical X rights price? Assuming that the rights are issued, after the rights issue, what should be the market price? Theoretically, what should be the market price? That calculation is called as theoretical X rights price. So what is the formula? It is market price before the rights issue, or this can otherwise be given as cum rights price. Okay, this can otherwise be mentioned as cum rights price. Market price before the rights issue for the existing shares, because the existing shares are already available in the market. So market price before the rights issue into existing shares plus rights price. Rights is the exercise price, and exercise price will be given for which shares? For the right shares. So for exercise price into right shares, the whole divided by existing shares plus right shares, which is already available shares plus right shares. Okay. So this is your formula for theoretical X rights price. Now always remember, this theoretical price will be less than the market price. Always. Theoretical X rights price will be less than the market price. So when it is less than the market price, naturally, if you are an external shareholder, you will get it at the market price only. Just because you are an internal, or the company is offering you at rights, okay, or just because the company is voluntarily offering you, it is giving you at a nominal price or a lesser price. That difference is a value add to you, and that is what will get covered under the adjustment factor. So adjustment factor is going to compare two things: market price, rights, X rights price. So market price before the rights issue divided by theoretical X rights price. Market price before the rights issue divided by theoretical X rights price. Okay. This will always be greater than 1, because market price will always be more than the X rights price. So the value adjustment factor will always be greater than 1. Now, what will we do with this adjustment factor? Okay. This adjustment factor is considered for weighted average shares calculation in the previous year, or in the current year and previous year. So for both the years, I need to consider the adjustment factor for weighted average calculation. Now how we will consider? Let us do a question to understand this formula. Question number 3. Okay. Question number 3. A1 Limited supplied the following information. You are required to compute the earnings per share. Net profit attributable to equity shareholders in 1718 is 1 crore. Yes, the two formulae are required. I think Jayashree, you're asking about the formulae. Please allow me to complete the question, then you will be able to understand it. Year 1819, 1 crore 50 lakhs. Okay, so which is current year profits. Number of shares outstanding before rights issue, which means existing equity shares is 50 lakhs. Rights issue is one new share for 4 each. So 50 lakhs divided by 4 or 50 lakhs into 1 by 4, we get 12 lakh 50,000 shares. Even if it is not given, we can calculate 12 lakh 50,000 shares. The rights issue price is rupees 96. Last date of exercising the rights is 30th June. And fair value of the equity share prior to the rights issue, which means the market value of the share before the rights issue was 101 rupees. So if someone had to go and buy from the market, they would have got it at 101. But since the company is itself offering it rights, it is giving at 96 rupees. Right? So this difference is what leads us to the adjustment factor. So step 1, you are going to calculate number 1, theoretical X rights price, number 2, adjustment factor or rights factor. Go ahead and calculate. Please calculate. So let's check the answer. The theoretical X rights price should be 100. So let's also check the computation. Market price before the issue was 101 into 50 lakh shares plus rights price 96 into 12 lakh 50,000 shares. The whole divided by 50 lakhs plus 12 lakh 50,000. So with this we will get the value as 100. Are you getting 100? Yes. So now the X rights price is 100, whereas the market price is 101. So 101 divided by 100 will give you 1.01 as the adjustment factor. Okay. Now this adjustment factor is what we are going to use for the calculation of EPS for after considering the rights issue. Let us first do it for current year, then go for the previous year. Is the theoretical X rights price means that the price that should have been after the rights has been completed. Okay. Now for current year, right? For the weighted number of shares, let's see when the rights has been completed. 30th June. So from 30th June, which means from 1st July, actual right shares have come into existence. Whereas for the 3 months, April, May, June, right shares were not available. But in adjusted EPS, we will assume as if the right shares, bonus and rights are available from the beginning of the year. Okay. For bonus, no consideration. So director, we added it. Added 12 months weightage. But here, partial consideration is there. That is why we are calculating adjustment factor. So now what we are going to do is, we are going to consider for the first 3 months, 50 lakh shares into 1.01, which means we are assuming that it is not 50 lakh shares. It is 50 lakh shares into 101 percentage, including the rights factor. For how many months? 3 months. 3 by 12. Okay. Plus, now after this 3 months is completed, which is from the month of July, we have 12,50,000 shares which have actually come into existence. The moment they actually come into existence, they are on par with other shares. So you can take them as total. What is the total? 50 lakh plus 12,50,000. 62 lakh 50,000 into, for the remaining months, 9 by 12. Because they are all treated on par, no adjustment factor required. Okay. So this is the weighted number of shares for the current year, which is 1819. Right? Now, for previous year, the rule of adjusted EPS says we need to consider as if the weighted average, the shares were available in the beginning of the previous year itself. So, which means for the previous year also, we will consider this rights factor for adjusted EPS. So, how do we consider? In bonus, what we did? We added the shares directly. In rights, what we will do? We will just multiply this rights factor. So, weighted number of shares is equal to 50 lakhs into 1.01 for entire year. So, directly just multiply, which gives you 50 lakh 50,000. This is for the year 1718. So, I am repeating the weighted average calculation for current year and previous year. Please listen once. For the current year, I need to consider the weighted average in two portions. First, pre-rights, then post-rights. For pre-rights, the total number of shares will be multiplied by the adjustment factor or rights factor into number of months. For the post rights, total number of shares, including the rights issue, will be considered. No adjustment factor will be taken. So, pre-rights alone adjustment factor will be taken. Post-rights adjustment factor will not be taken. Rule clear? For previous year, one rule. Total number of shares into adjustment factor. We are adjusting the shares as if the rights happened in the previous year. Okay? So, this is for your previous year calculation. Right? Now we are going to calculate, now that we have found out the weighted number of shares, final answer is when we calculate the basic and adjusted EPS. So, for the year 1718, which is preceding financial year, the original profit was 1 crore. And what is the original number of shares? The original number of shares is 50 lakhs. So, therefore, basic EPS for previous year is 1 crore divided by 50 lakhs, which is 2 rupees per share. Okay? Whereas, for the same previous year, we are adjusting the EPS. Why are we adjusting the previous year EPS here? Because current year rights have been issued. So, we need to show corresponding figures in the preceding financial year. That is why we do this adjusted EPS for bonus and rights. Okay, else the EPS numbers will show very wrong image because of the change in the denominator. So we are doing this adjustment. So now going for the adjustment for 1718, the restated or adjusted EPS as we would call it, whichever term can be used. Okay, restated or adjusted EPS is 1 crore, same profit, divided by 50 lakh 50,000, which is what we calculated as the weighted shares, which gives you 1.98. Now for the current year. Now coming to the current year, there is no concept of restatement. You are not changing something. Current year itself rights was issued. So which means current year basic EPS itself will be based on the rights issue only. So current year EPS, okay, basic EPS for current year is going to be numerator, the revised profit for the current year, which is 1 crore 50 lakhs, divided by, we have calculated the weighted average shares, 59 lakh 50,000. So 1 crore 50 lakhs divided by 59 lakh 50,000, which gives us 2.52. Is that clear? Okay. Suppose if the question asks bonus, basic EPS will remain the same. In adjusted EPS, instead of multiplying the factor, you will just add the bonus shares. Similarly, in the current year EPS also, we will directly add the bonus shares with the weightage. How much? 12 months weightage. So into 12 by 12, we will do the weightage. So for bonus, directly add the number of shares. Only for rights, we will multiply the adjustment factor. Okay. So this is about restated EPS or adjusted EPS for bonus issue and rights issue. So far clear, friends? Any doubts in restatement of EPS? Right. So if this is clear, we move on to the next area of discussion, which is the third part. So we have seen basic EPS, we have seen restated or adjusted EPS. Now the third type of EPS or the another EPS that we are going to see here in AS20 is diluted EPS. Diluted EPS. What is diluted EPS? When the company has dilution of capital. Okay, dilution of capital is any form of liability which gets converted to capital in the future. So what are all liabilities that can get converted to capital? Debentures, preference shares. For equity shareholders, even preference shares are external liability, right? So preference shares which are convertible to equity. Employee stock options which can be potentially given as equity shares, right? So effectively 3 points you can remember: convertible debentures, convertible preference shares, issue of employee stock options. So in all these cases, there is a chance of issue of equity shares in the future. So we need to calculate diluted EPS to show what if the amount is, sorry, what will be the EPS if the shares are diluted. So which means you will accordingly change the denominator and numerator to include these additional shares and calculate the EPS, for which the formula is going to be diluted EPS is equal to diluted earnings divided by potential equity shares. Divided by potential equity shares. Now, two things here to remember. What is diluted earnings? What is potential equity? Now, what is diluted earnings? We all know what is earnings available to equity shareholders. Now, if earnings available to equity shareholders is without the scenario of convertible preference, convertible debentures, whatever it is. Now, suppose If the debentures are going to get converted, will we pay interest on debentures? No. The moment they get converted, interest on debentures will get nil. So we are going to add back the interest. So add back the interest, because now if the interest is not going to be paid, your profit will increase. So add back the interest. But remember, interest is tax deductible. Interest has tax benefit. Okay, so debenture interest has tax benefit. Now if I'm going to add back the interest, profit will increase. So I have to pay tax on that additional profit. So we have to provide for that adjustment. So minus tax. So add interest minus tax. So instead of that, I am doing it as a direct formula, which is debenture interest into 1 minus tax rate. So into 1 is basically to add the interest, minus tax rate is to subtract the tax portion. So plus debenture interest into 1 minus tax rate. Suppose if the conversion is from preference shares, then what we will not be paying to the shareholders? We will not be paying dividend to the shareholders. Again, that will add back to your profits or reserves. So add preference dividend. Now earlier preference dividend had dividend distribution tax, but now it is no longer applicable. So in your revised materials also it is no longer applicable. So we are not discussing on dividend distribution tax. So diluted earnings is adding back these components, we are calculating the revised earnings. So the formula I repeat, earnings available to equity shareholders plus debenture interest into 1 minus tax rate minus preference dividend. Right? Now to the denominator. Potential equity shares. Potential equity means future equity, which means whatever is your existing equity shares plus whatever can be the future equity shares after conversion. Okay, so if one debenture can be given 2 shares. So if you have 100 debentures, how many shares can we have? 200 shares. So 200 will get added. So potential equity is very simple, current equity plus future available equity. So this summarizes your diluted EPS formula. Okay, so remember in diluted EPS both numerator as well as denominator undergoes a change. Okay, and in every profit and loss statement, both basic EPS and diluted EPS will be shown whether or not there is a change. Even if you do not have any dilution possible, we need to show in the financial statements basic EPS, diluted EPS. Okay, so this is in summary of AS 20. Quickly run through and we will go to the balance questions. Yes. It depends on what is the rate that is given, what is the benefit that is given. Shall we start with the question? So we first start with a theory question that has been asked from your May 2022 RTP. So let's first answer that. Question number 1A. Stock options have been granted. So stock options is employee stock options have been granted by AB Limited to its employees and they vest equally over 5 years. That is 20% at the end of each year from the date of grant. The options will vest only if the employee is employed with the company at the end of the year. So which means the stock options will be eligible only if the employee is employed in the organization. If the employee leaves the company during the vesting period, the options that have vested can be exercised while the others will lapse. So if he is leaving within the period, to whatever extent he is become eligible, they can exercise, whereas the balance options will be lapsed. Currently, AB Limited only includes the vested options for calculating diluted EPS, which means they are only considering the options that have become eligible. Should only completely vested options be included for diluted EPS? Is this in accordance with the provision? One simple point for us to answer here. Diluted EPS will be based on potential equity shares. Potential equity shares will be calculated on the date of vesting, which means on the date of completion of criteria or on the date of grant. It is calculated right from the date of grant of the option, which means the moment you open the scheme, potential equity becomes available. So, which means that potential equity calculation will be based on the grant of the option, irrespective of how many shares have got vested. So, we are not worried about how many options have got eligible, will get eligible in the future. We should calculate it based on whatever is available in the beginning of the year or at the end of the reporting period. Right? Accordingly, future years, if the amounts are changing, we can keep changing the potential equity shares. But in the year beginning itself, we cannot assume that I will take only the vested options. I should take the entire options for consideration. Okay. So remember, for diluted equity, the options have to be taken from the grant date and not only for the vested options. So let's see the answers. The current method of calculating diluted EPS adopted by AB Limited is not in accordance with AS20. The diluted equity share should include all potential equity shares. In the word vanduchna, your answer key is satisfied. This is the keyword. Okay, all potential equity shares. That is all stock options granted on the balance sheet date, which are dilutive in nature irrespective of the vesting pattern. The options that have lapsed during the year should be included for the portion for the of the period the same were outstanding as required by the standard. So which means if the options have got lapsed after 6 months, for the first 6 months we should include the diluted shares. Then next 6 months we can exclude the lapsed options. So basically the crux is granted options need to be considered. We should not consider only the vested options. Right? Is the rule clear, friends? Okay. Next. X Limited, as at March 31st, has income from ordinary operations 2,40,000 and loss from discontinuing operations 3,60,000. Accordingly, a net loss of 1,20,000. Company has 1,000 equity shares and 200 potential equity shares. You are required to calculate basic and diluted EPS. So, what is the formula for basic EPS? Earnings available to equity shareholders divided by number of shares. Now, here the question is, what is this earnings? Is it 2,40,000? Okay. Or is it 3,60,000 including 3,60,000 loss? Which means, should I take only the ordinary operations or should I consider all extraordinary or discontinued operations also? The logic is very simple. Earnings available to equity shareholders of the company. They are eligible for all the earnings irrespective of whether it is profit or loss. Which means whether ordinary or discontinuing operations, both needs to be considered. So now what will be the earnings here? It will be 2,40,000 profit minus 3,60,000 loss. Which means your earnings is going to be minus 1,20,000. So calculate the basic EPS. Minus 1,20,000 divided by 1,000 shares. You have to say what is the loss per share. 120 rupees loss per share. So you should write basic EPS within brackets 120. Okay. Basic EPS within brackets 120. Similarly, diluted EPS. They have not given any diluted earnings. Just potential equity shares are given. So what is the formula? 1,20,000 loss divided by 1,200 shares. 1,20,000 divided by 1,200 shares, which gives you diluted EPS of minus 100. So within brackets 100. Formula is very simple. Okay. But the only crux here is about understanding that for earnings per share, we need to take total earnings. Avadada rule. Okay. Rather, I believe you are asking about vested options and granted options. We will discuss it in detail again when we are learning ESOP. So please wait for that. At that time, we will also discuss it in length. Okay. So clear with the question number 1 and 2? Yes. Diluted EPS answer is 100, Jayashree. 1,20,000 loss divided by 1,200 shares. Right? So this is question from your RTP May 22. Next. Question number 2. This is a practical question. At the time of calculating diluted earnings, effect is given to all dilutive potential equity shares that are outstanding at the end of the period or outstanding during the period. Is the statement correct or wrong? At the time of calculating diluted earnings, effect is given to all dilutive potential equity shares. Why the word all dilutive is important here? We are going to consider not the shares that are at the end of the year. From the beginning of the year, whatever is available as potential equity shares will be considered on a timely basis or on a time factor basis. Comment. So we are going to say about the statement. Also calculate basic and diluted shares for diluted earnings per share for the given case. Net profit 64 lakh 12,500. Number of equity shares 15 lakhs. Number of 9% convertible debentures issued as on 1st July. Okay. So why this 1st July is important? It is not issued in the beginning of the year. It is only issued in the middle of the year. Okay. 75,000. Debenture is convertible into 8 equity shares and tax relating to the expenses 35%. So shall we go ahead and do the computation? Okay. Now, first what we need to calculate? We need to calculate diluted earnings. Okay. Diluted earnings is equal to 64 lakh 12,500. Okay. Plus, what is the interest on debentures? 75,000. 75,000 is the number of debentures. It is not the value of debentures. So 75,000 into 100 into 9%, which gives us 6 lakh 75,000. Coming to it. Okay, 6 lakh 75,000 into 1 minus tax rate, which is 1 minus 35%. Correct? Yes. So you would have done 6 lakh 75,000, correct? 75,000 into 100 into 9%. What is the value that you got? 6 lakh 75,000 into 1 minus tax rate But remember, 6,75,000 is wrong. Because debentures have been issued on 1st July. So, which means debenture interest will be calculated not from April. It will be only calculated from July. So, here, what is the most important point that we have to remember? Date of issue of the instrument is important. So, if the question says it was issued already existing or issued in the beginning of the year, no problem. But if we ignore the date, we will tend to get a wrong diluted EPS. So, for interest expense for 9 months, it is 75,000 into 100 into 9% into 9 by 12. 5,06,250 into 1 minus 35%. Now calculate your diluted earnings and give me the value. You should be getting 67,41,562. 67,41,562. Highlight that 1st July and make a note of it saying the date of issue of the instrument has to be remembered. Okay. Now we go to the calculation of the denominator, which is potential equity shares. Okay, now listen here. For potential equity shares, we have 75,000 debentures, which can be converted into how many shares? 8 equity share per debenture. So 75,000 into 8. How much is the potential equity shares? 6 lakhs. But this 6 lakhs is available from which date? From the date of issue of debentures only, which is after 1st July only, the 6 lakhs has become potential equity. So for April, May, June, there was no potential equity. Correct. So we are going to do for weighted average shares for denominator 15 lakh shares, original 15 lakh shares into, okay, let's do it in a different manner. I mean, in the normal manner. I mean, this formula is also right, but I will do it in a manner that we can easily remember. 15 lakh shares into how many months? 3 months. 3 by 12 plus for the remaining 9 months, we have 15 lakh already existing shares plus potential equity shares amounting to 6 lakhs. So 15 plus 6 is how much? 21 lakhs into 9 by 12. Which gives you 19 lakh 50,000. 19 lakh 50,000. So here, both in the numerator and denominator, that 9 months criteria is applicable because the date of issue of debentures is not beginning of the year or previous year. The date of issue is current year, middle of the year. Okay? Highlight it and make a note of it. So therefore, now calculate. They have asked 2 questions. Basic EPS, diluted EPS. Basic EPS formula is going to be very simple. 64 lakh 12,500 divided by 15 lakhs, which is 4.28 rupees per share. Okay, 4.28. EPS is 4.28. And diluted EPS is what we have calculated now, which is 64 lakh 41,562 divided by 19 lakh 50,000. 3.46. 3.46. Okay, very simple, but the only crux that we might tend to miss out here is that 1st July. Okay, and the one miss பண்ணிட்டீங்கன்னா answer full மாறிடும். So remember to check the dates before you do the calculation. Am I clear, friends? So this is question number 2. Any doubts? Okay. Second, in the following list of shares issued for the purpose of calculation of weighted average number of shares, from which date the weight needs to be considered? The basic rule for EPS is weights will be taken from the date on which shares were outstanding. From the date on which shares became outstanding or available. In the underlying pointer, you can remember from whichever date share will become available, that will be the date for consideration. Now let's see in each scenario. Equity shares issued for exchange of cash. From which date the shares will become available? From the date of allotment or date of issue. So for the first one, answer is date of cash receivable, or which is nothing but date of allotment. Second, equity shares issued as a result of conversion of a debt instrument. So I am converting a debenture or a debt instrument to share. From which date the shares are available? From the date of conversion. From the date of conversion. Next, equity shares are issued in exchange of settlement of a liability of the enterprise. So, like for a creditor, I am allotting equity shares for settlement. So, is it the date of purchase or date of settlement? Date of settlement, because that day only equity shares become available. So, date of settlement, date on which the settlement becomes effective. Next, equity shares issued for rendering of services to the enterprise. Date on which service has been completed. So, date of completion of service. Next, equity shares issued in lieu of interest and or principal of another financial instrument. So, in lieu of means in exchange of. Okay, in exchange of paying principal or interest, I am allotting equity shares. So, whenever the interest is due or whenever the allotment is made, I am exchanging the interest with shares. I am saying I will not pay you interest, instead I will give you the share. So the date on which this exchange takes place. So on that date, what will happen? Shares will become effective, interest will get stopped. So your answer will be the date on which the interest ceases to accrue or stops to accrue. The day, or you can write the date on which interest is not being charged, or date from which interest is not being charged. That is what the accrual date, right? No, right? Use terminologies as accrual. Next, equity shares issued as consideration for acquisition of an asset other than in cash. Date of purchase, purchase agreement, or date of acquisition. So here all the points come to only one rule. The date on which the shares become available should be, or outstanding should be, the date on which weighted average should be considered. Right? So this summarizes AS 20, the first standard for the day. Right, friends? Any doubts in AS 20? Clear? Any doubts, friends?